Well, joining us now to help unpack Abil's results and Leon's resignation is Feroz Basa, Portfolio Manager at Old Mutual Investment Group ELECTUS. Feroz, good to speak to you again. It does seem as though Abil is the one thing that keeps us in contact. But let's touch on the sad news story, essentially. Is a strong leader here who has decided to fall on his sword. And unfortunately, the market reacting very negatively, spurring the share price to fall quite substantially. But the Reserve Bank coming forward now and saying they're going to work with Abil to find a long-term solution. Is there something new happening in the corporate environment?
I think with Abil, because they are bank, Google, it's more and more important for the Reserve Bank to come in and reassure investors that they are there. You know, Leon was the co-founder of the business, so it's sad in a way to see him leave the business. But I mean, if you look at where Abil's been and where it is today, you know, something had to give. If one looks at all corporate turnarounds in South Africa, I mean, more recently, you know, Marion Roberts, when it came off significantly from 100 Rand to, I think it went close to 20 Rand, you know, there's always been management changes. So, you know, I think the share price reaction is largely on the back of, you know, it's got worse, the environment's got worse in South Africa, the business is in a worse position. There's potential of shareholders having to plug in another 8.5 billion worth of fresh capital into the business. Consider the fact that today the market capitalization is only 4 billion, so, you know, there's been a significant downward trend in the business itself. So, you know, I think a negative reaction on the back of a much worse than expected update from African Bank.
Feroz, let's touch on that capital raising initiative there. You mentioned 8.5 billion Rand. This does seem as though for any investors who are out there, they're going to need some strong substantiated numbers or some kind of details, as well as renewed confidence to be able to invest in the company.
Yes, I think when we spoke last time, Gugu, there was a few things that I think were outstanding in terms of an investment case for African Bank. One was making sure the core tier 1 capital was correct in the bank itself, and making sure, you know, the bad debts was at a level that was comfortable for shareholders to say there was enough written down for the current environment. The other thing was LRNs needed to be dealt with, and also what they made on the insurance business, that needed, the regulation was coming in to regulate that part of the business. So LRNs has still not been dealt with, a loss-making entity, volumes are negative, costs are increasing significantly. So I think it's going to be very difficult for shareholders to come in and say, you know, we're going to put in more capital and try and justify that without having all the detail on what's going to be done with LRNs in terms of the credit regulation and the big impact they're going to have to take on profitability, you know. So all these things are still up in the air.
I want us to explore LRNs as well, that you just mentioned a moment ago. That is certainly still a problem child. Are there any particular takers for this company? Maybe the likes of JD Group, now that Steinhoff has got a lot of money in the kitty in order to support such a transaction.
Look, if I look at the furniture industry, it is as well is overtraded. So, you know, I can't see why the likes of JD or even Lewis or any of the other players would want to buy LRNs, because effectively they're loss making, and there's huge leases on those properties that they have, and it would be easy just to take market share on LRN's demise. So actually a loss making entity with lots of leases in places, you know, huge impact on customer retention, the collections in their book. So I can't actually see how Steinhoff would want to buy LRNs at this stage, or any buyer that is for that matter. Just on that point, you know, initially we thought African Bank would need to raise in the region of 4 to 4.5 billion capital, and that would be sufficient for the bank and the likes of plugging all the holes. But, you know, they've come out and said they need 8.5 billion. Now, judging by the losses in the bank and what's happening in LRNs, this could be that, you know, this capital is required to deal with LRNs as well.
Feroz, there's another unsecured player in the market, Capitec, which on the other hand has performed incredibly well. Are there particular lessons that Capitec's management can learn from the fall of African Bank?
Well, I think if you go back and you look at Capitec, right, they're a very conservative group. They provide for loans much quicker than African Bank, and you know that set them in good stride in this downturn. Also, it's a different business model where Capitec wasn't a retail bank, weren't taking in deposits. Remember, when you take in deposits, you can on-lend that to clients at a higher rate and make that the spread on the interest rate. Whereas African Bank was relying on capital from the debt markets, the capital markets, and that's more expensive capital. So, you know, you've got fee income that you generate in Capitec from the business model that they run. You have the cheap deposits that you can on-lend, and they're conservative. So I think that the business model is totally different, and you know, I think that's why Capitec are in a position they are in, and African Bank is close to raising capital again.
Feroz, such a pleasure speaking to you as always. That was Feroz Basa. He's a portfolio manager at Old Mutual Investment Group, ELECTUS.